Let's jump right into this explainer by tackling a feeling I think we all know way too well. So, picture this. You just had a brutal month at work. You're slaving away, putting in the crazy hours, you finally check your email and boom, you see you've been paid $2,000 for the month. You're feeling great. But then you check your actual bank account, and the deposit is, like $1,456? Instantly, that anxiety just sets in. You pull up the pay stub and it's just a laundry list. Federal tax, state tax, Social Security, Medicare. And you're just sitting there thinking, where on earth did it all go?
You know that feeling, right? You might literally feel like invisible forces are constantly draining your bank account, taking this massive chunk of your hard-earned cash in this weird modern ritual where they just expect you to hand it over and say thank you. Honestly, it can feel like you aren't even the one in control of your own financial destiny.
But here is the really good news. Instead of seeing the whole financial system as some sort of adversarial mystery that's totally rigged against you, we are going to reframe it today. The system, it's just a machine. It's a game with a very specific set of rules. And if you learn those rules, you can absolutely stop feeling like a pawn and learn how to actually play this game and win.
So here is our roadmap for today. 1. The house rules. 2. The invisible forces. And 3. The cheat codes.
Part 1. The house rules, taxes, banks, and money. Let's just start with the everyday financial chores we all have to interact with.
Okay, let's talk about taxes. They're essentially the subscription fee for civilization, right? And yes, it is incredibly annoying to play this bizarre guessing game with the government every single year when you file, where they already know exactly what you owe, but if you guess wrong, you're cooked. But these taxes do actually fund our world. You've got income tax on what you make, sales tax on what you spend, and capital gains tax on the money your investments make while you sleep. Then you have Social Security, which is basically forced retirement savings, and Medicare, which is a health insurance tax. The reality here is that countries with higher tax rates generally use this money to fund roads, build schools, ensure your favorite taco truck isn't infested with rats, and just build a generally higher quality of life.
Moving on to banks. Look, when you deposit $1,000, it doesn't just sit in some giant vault guarded by a dragon. Banks are really just matchmakers. Through a system called fractional reserve banking, the bank takes, say, $900 of your deposit and immediately lends it out to someone who wants to buy a jet ski. They only keep a tiny fraction of the cash on hand. They rely on the fact that not everyone is going to want to withdraw their money at the exact same time. Well, unless it's 2008, of course. But generally speaking, your money is safe, especially with the U.S. government insuring deposits up to $250,000.
And what even is that money going into the bank anyway? The weirdest part about currency is that it's completely a social construct. I mean, the only actual difference between a dollar bill and a stick you find out in the woods is our shared social agreement. We collectively believe that the printed piece of paper has actual value to settle transactions for goods and services, while the stick obviously doesn't. If the government prints too much of it, it literally becomes monopoly money. So trust is the absolute foundational bedrock of this entire system.
Part 2. The invisible forces, interest, inflation, recessions, and credit. Let's introduce the invisible gears of the economic machine that quietly dictate your financial reality.
First up is interest. Think of interest as basically money's way of charging rent to exist in someone else's hands. Simple interest? That's just a flat fee for borrowing. But compound interest? Oh man, that means every single dollar you have creates clones, and those clones also start charging rent. It's a massive double-edged sword. On a 20% credit card, it is an absolute time bomb where a $12 burrito quickly morphs into a $50 regret. But on the flip side, earning a 7% annual compound interest on an investment means your money duplicates itself like a literal cheat code.
Then you have inflation. Have you ever bought a bag of chips, opened it up to find it's half empty, and then realized you paid 30% more for it than you did last year? Yeah. That's inflation. It is the slow, quiet erosion of your money's value. Your $5 bill is still $5, but it buys way less instant noodles and way less gas. This usually happens when too many people have cash and want the exact same stuff. Like, say 2,000 people want a $500 TV. The store realizes this and just raises the price to $800. Too much money, chasing too few goods. Governments try to fight this silent thief by raising interest rates, which makes borrowing expensive and cools off all that extra spending.
Let's look at how this builds into the broader economic machine. It's essentially a giant party cycle driven heavily by debt. During the boom phase, credit is super easy to get, so people borrow to spend more. And here's the key. Because one person's spending is literally another person's income, the whole economy just dances. But eventually, that debt grows faster than incomes, reality hits, the lights flicker, and we enter the bust.
Borrowing stops, spending drops, and the whole system resets. Recessions feel awful, but they aren't forever. They are a painful but totally natural deleveraging process, eventually clearing the way for rebuilding and growth once again.
Because our entire economy runs on borrowing from our future selves, lenders need to know they can trust you. And that boils down to a shadowy, 3-digit algorithm, your credit score. Ranging from 300 to 850, if you are below 580, you're pretty much a walking red flag to lenders. Over 750, and you are sparkling with adult credibility. Your score is calculated using things like credit utilization, account age, and your mix of credit. But payment history is by far the biggest piece of the pie. Think of your credit score like a pet dog. If you totally ignore it, it poops all over your life and stops you from getting a house or a car. But if you feed it by actively managing these specific factors, it opens pretty much every door for you.
Part 3. The cheat codes, value, investing, and time. Now that we understand the rules and the forces at play, let's pivot to the offensive strategy.
The ultimate cheat code? Understanding that value is entirely perceived. Think about it. Imagine picking up a rock. Okay, now imagine that rock is shiny and yellow. Bam, that's gold. It's not inherently more useful than a regular gray rock. It's just worth more because we humans placed a higher value on its rarity. It's the exact same reason a Gucci or Louis Vuitton handbag, which, let's be real, holds your keys just as well as a bag from Target, can sell for literally 100 times the price. People perceive it as more valuable. If you can provide immense perceived value, like Steve Jobs did with the smartphone you might be watching this on, people will absolutely line up to hand you their money.
The way you actually capture that value over the long haul is through the investment menu. You can buy stocks, which are just tiny ownership slices of actual companies. You can buy bonds, which are simply loans you give to governments or companies that they promise to pay back with interest. You can buy funds, which are automated, bundled collections of those stocks and bonds so you don't have to stress over picking and choosing. Or you can buy real estate, property you buy hoping someone else pays to live in it. So the absolutely crucial takeaway here is that investing isn't about getting lucky or, treating the stock market like a lottery ticket. It's about a fundamental shift in how you operate. Right now, you probably trade your highly limited hours for a paycheck. 1 hour equals 1 paycheck. But the truly wealthy have figured out how to shift away from trading their time to trading their money for more money. They make their capital work a full-time, 24/7 job for them.
Now, obviously, investing comes with risk. You hear that all the time. Markets will inevitably go up, and markets will definitely go down. It can feel really scary to put your hard-earned cash into a system that fluctuates like that. But honestly, the real danger isn't participating in the market and facing a few temporary drops. Actually, scratch that fear. The actual danger is keeping your money perfectly safe in a shoebox under your bed, or letting it rot in a zero-interest savings account, and letting that invisible force of inflation quietly steal your future buying power. By doing nothing, you aren't keeping your money safe. You are literally guaranteeing that your money loses value every single year.
The absolute ultimate asset in this whole financial game isn't a hot stock or a fancy bond. It is the number 30. Giving compound growth 30 full years to do its magic is the ultimate equalizer. Seriously, it is exactly how ordinary people working totally regular jobs with modest paychecks manage to retire with 7-figure portfolios.
Because wealth isn't built in days or even weeks, it is built in decades. Money that sits in an investment multiplies slowly at first, but then it scales exponentially faster as the years roll on. $100 becomes $200, then $400, then $800. It proves that time, not luck, not even a massive starting income, is the single greatest force in the entire financial system. You just have to be early, be diversified, and be incredibly patient.
So, now that you know the house rules of taxes and banking, the invisible forces of the economic machine like inflation and interest, and the cheat codes of investing and compounding, you have to ask yourself this one final question. When you look at your life right now, are you making your time work for you, or are you just going to keep working for your time? The board is set. It's your move.